So, Mark, I hope you had a good weekend.
I
This
did. How about
is
you?
was interesting. Spent spent a lot of time in Atlanta airport. Fun.
Always a fun
Um,
place.
oh yeah, entertaining. A lot of characters, number of bars, so it's all worked out well. So
Yep, that sounds good.
yeah. Well, this is the week of June 12th, and Mark and I, and hopefully Drew will join us here soon. We're just gonna hit upon what we think is happening in the markets for the coming week and hit up highlight some different individual positions and go from there. Um, Check out our swing trading program on the Discord. We'll have a link below. Check that out. Mark runs that. Mark and Drew run that. And their accuracy is really incredible. And I think in a market like this, where you get a lot of big swings, you can really capitalize on it. So it's very educational, includes a handful of 3 different lists of opportunities each week. So check that out. Click the link below, and if you will, hit the subscribe button. So Mark, what's your take on this busy week of data and Fed and all the other stuff?
Well, Monday and markets closed. We're up, you know, 0.56% in the Dow and 1.5 points in the Nasdaq, and the S&P closed over 4,300 for the first time since when? August or October? Somewhere in August.
13 months, they said.
13 months, yeah. So
Yeah.
yeah, it's up another almost a point percent. But then you look over and New York Stock Exchange has 48.7% advances with 47.5% decline. So it's about even. The NASDAQ's a little better today. It has 55% advance, 40% decline. So, it's broadening a little in some of these areas, but, it's still not to a point where everyone is participating in the market. I think today is just people and investors trying to get ahead of tomorrow's news on the inflation, and then Wednesday's news on rate hikes and or pauses. I don't think we'll have a cut, but I think there's a lot of anticipation in the market that we're going to see a pause or a skip or whatever they want to call it now. I personally believe that we'll probably see another quarter point rate hike with the markets tearing off like they're doing. With unemployment situation in the jobs report. But that's just my speculation. But I haven't heard too much from the contrary from the Fed governors and presidents that I've heard talk. So I think they probably want to just keep going until they figure out that they need to stop. And it doesn't seem like they've broken enough yet for me.
No, it doesn't. I think just when you look at it from the surface, the headlines, it doesn't seem like much has been broken other than, they keep talking about inflation. Unemployment is still low. I think it's still at 3.7%. And I believe, based on some testimony from Jerome Powell a couple months ago, that 4.6 was sort of the target. So that's a pretty big jump. Um, and we're just not, we haven't seen the numbers yet. So I think they'll raise. I think they'll raise 25 bips. Um,
What do you
and
think that'll do? What do you think that'll do to the market since everyone thinks, they're going to pause or skip or
I think I think it'll be, it will run the market up a bit in the afterwards after they announce, and then I think it'll pull back and it'll start selling off. I think what I look at is a lot of what are the bigger institutions doing, and based on some reports last week, it's indicating they're unwinding their short positions. So they've gotten squeezed, and we needed that big squeeze, and short squeezes push markets higher because of the mechanics. Well, now these guys who've been basically decimated for the last month or so, 2 months, are now they're like, I'm bleeding at this point. I've got to cover my short positions and get out of this, because if they do pause or skip whatever they do at the Fed, that could really rally the market, and could just wipe out a lot of big hedge fund and institutional investors who have been short this whole rally. Historically, when that unwinding happens, typically that's when the floor is being pulled out from under what has pushed this market higher. And without the shorts, the market doesn't have much further to go. So I anticipate they'll raise, and we'll get some, movement. And then I think you're going to start to see this thing sell off a bit. I don't know if it's the 20-30% catalyst that'll drive it, but I do think it'll pull back off of all the gains it's made since mid-May. So it just makes sense to me in that way.
Okay. Yeah.
So Drew, what's your take on the market this week, and with everything that's going on?
So I think, with the CPI report coming out, I think it's going to be pretty good compared to last year. And I think there's a lot of discussion about now deflation coming up. And what I'm actually looking for, I'm curious to see what's going to happen, but I think a lot of people are thinking that, inflation is going away. The FOMC meeting, if they really, halt the interest rate, Fed fund rate increase, I think there might be a possibility that a lot of people are waiting on the sideline to see what happens. And if the halt or there's no increase on the Fed fund rate, I think a lot of people, there might be, at least for a short term, a rally in the market. But I'm just, waiting to see. I'm not doing anything. I want to see how it works out. And I'm really, really, really curious to see how the CPI and the FOMC this week will come out.
Yeah, Mark and I were talking earlier about that, and just the talk about that. Every meeting, the headlines are like, they're going to pause. Are they going to pause? Are they going to skip? And we've talked about this in the past, but I always go back to what is there two things that drive all this, and that is to squash inflation and to increase unemployment. And I think Mark's analogy last week when we talked about you could have 4 jobs and Mark's got 3 jobs and I got 2, that just counts for 12 jobs out of 3 people, and they look at the 12 jobs. And so I look at it and I go, the reasoning to stop raising rates, I just don't think is there yet. And so I don't know. I mean, they could surprise us and they could get smart real quick and skip or pause, or if I don't see them
that's
dropping.
very interesting. I never thought about that, but even for myself, I have 3 jobs right now, 3, 4. But when we talk about unemployment rate and people saying that the unemployment rate is low, is this how that counts? So for you, me, and Mark, would that be 12 or 13 people with a job? Is that how that's counted?
That's how they see it.
Oh, so that's interesting.
Right. A little crazy.
Right.
But you and I, but between the 3 of us, we all have 12 jobs.
Right.
But they don't look at the fact that it's just 3 people who have 12 jobs, not 12 people who have a job.
It's interesting to me, just locally, how economies work. And I go out to eat quite a bit, and used to be people, over a year ago they'd stay out later than they do, and the restaurants and bars would stay open until midnight. Now by 9:30, in the places I go to, they're pretty quiet and gone. And then we're doing some work on the house out here, and before, trying to get somebody to come out and do anything took forever. Now I got people showing up, and I was talking to one guy who's looking at something I need done, and he's like, yeah, he says the new housing construction slowed way down, so I'm getting to anyone who needs repairs or anything. Before, I couldn't get to them because they were building houses. And then we tore out some carpet and put in a floor this weekend, and we've been waiting for over a year to get somebody to do that. And then he finally just called and says, hey, I got nothing going, out of nowhere,
Wow.
So I kind of look at those things and go, okay, something stopped, that they're
Yeah.
calling me now and I'm not sitting waiting anymore. So it's just
I
my local economic barometer.
yeah, well, I'm down here in tourist heaven, and I had to go in to one of the neighborhood areas that is popular with tourists, and found a parking space, went in, went to the bank, did some things, drove out, didn't just drove down the main stretch of called Highway 30A, and like I would say it's a quarter of the amount of people that I'm used to seeing at that time, say a year ago or 2 years ago. Um, we're just not seeing as many people out vacationing like the last couple of years, which is interesting. I mean, it's interesting, especially, I mentioned last week I had coffee with a buddy of mine who's in the business and in the mutual fund business. And he's like, it's expensive to go on vacation down here. He's like, it's expensive to eat. And I think people are starting to like tighten up a bit. Um, and I'm
I
curious
think
to see what it looks like later this summer.
right.
Well, you'll see me down there. So
There you go.
uh you know that video I showed you about Stanley Druckenmiller's interview?
Yeah.
I found it really interesting that he was saying in a normal case there should have been a recession or a hard landing, but because this recession is so anticipated, it's getting delayed. And usually in a recession there should be he's worried more about not the inflation or Fed fund rate, but he's more concerned about the growth in the market itself.
Hmm.
And he was saying that he thinks like 20-30% down is anticipated. But he also brought up a point where because there's so much people waiting for this crash, there's so much money on the sideline. And I was saying in the dot-com bubble, even at that point, with the internet boom and all that, the melt up ran up 2-3 years. And he was saying that if this artificial intelligence cycle is real, which he thinks it is real, like NVIDIA, AMD,
Hmm.
he's saying that this run up at this situation will not be just 6 to 10 months, but he thinks there might be a run up for about at least more than 2-3 years. Of course, he said he might be wrong, but it was quite interesting to hear what he said
Yeah.
on how people are preparing for this crash or recession.
Well, it's interesting. Like, if you think about it from a perspective of large speculators shorting this market, it's especially the S&P, it's humongous. I mean, it's like historical numbers. Well, that just manufactures higher returns. And it's because everybody said, what they've been for like a year and a half, we've been talking recession, 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 recession. We see it in the economic numbers. We see it in, credit card delinquencies. We see it in, you know, uh, this is one that blew my mind. Capital One cut their dealer credit lines to auto dealers. Like, there's a handful of banks and lenders who are like, we're not lending to car to people who want to borrow money, and Capital One's one of the biggest. Um, and
same
it's
situation. We're out in California with Drew. How many two insurance companies aren't insuring homes anymore?
yeah, what
State
State
Farm and I
Farm?
forget the other. Yeah,
Yeah, yeah. I think it's the underlying credit is tightening, yet there's so much anticipation for recession. So let's just short the market. Let's short the S&P. Let's short the Nasdaq. Let's short Tesla and all these stocks. And in turn, so much of that's being piled on, and it's driven the market higher. And I think I mean, just the simple mechanics of that is just, I think, maybe Sam or Stan Druckenmiller is absolutely right. And I think Steve Cohen has said the same thing. AI will end the year higher. It may just be seven stocks that push the whole thing, but I don't know. I guess the economic side of it, economics don't make a whole lot of sense to me but when it comes to just the anticipation of a recession, you get short, you sit on the sidelines, you buy money market accounts, that kind of thing. well, that would explain a lot of this. So question is how much longer does it go?
Right.
You know, so
And the other point that I agreed and I really liked what he said was that just because the hard landing is postponed or delayed doesn't mean it's over. It
right,
just means that it might get more steep or deep, but like more
right.
worse. So he was saying that he actually did. He was saying that he's looking for later this year or later next year. But the other thing that was interesting is I was driving, here in California, and I saw that I went by a Wells Fargo, and there was a sheet, something on the window saying that we could only withdraw less than $1,000 per person. So I was like, "Oh, really, is this happening? It's Wells Fargo's, and
Wow.
so the first time I saw that, and I see a lot of here in California, a lot of gyms, a lot of like dancing classes saying that you could register for a month, but you could like so it's not 1 month, but you could get the same price for like 2-3 months. So there isn't much of a demand, and they're
Oh,
trying to
wow.
get more people. So
Well,
I
you
see
guys
that.
are experiencing some really big corporate closing, especially in the San Francisco area. It sounds like everybody's exiting San Francisco at this point. From a corporate standpoint, I think it was, well, Wells Fargo, I'm not Wells Fargo. Whole Foods closed their flagship store there. Um, Old Navy's doing the same thing. Handful of others, and I guess, and from what I understand, the new law is you can't chase down shoplifters anymore in the state of California. You have to just let them go. I'm like, how does that work? You know, but I don't know. I'm curious to see sort of if there's another move in migration to the southeast or Texas or something like that if we get another spurt in the next 12, 24 months or so, just because of some of the law changes out west and people, enduring smoky cities like New York City. We're going to see a migration this way. So I don't know.
No, we had smoke for a couple of weeks, but no one cared about our lungs here in the flyover country.
Right.
We just lived our lives as normal.
Yeah. Yeah. Um,
I had a question for you guys. I think I always ask this because I think I'm the one that's most less experienced in the market. But when you guys went through the subprime and the .com, was there any anticipations like we have these days about a
I,
crash or a recession? Were there anyone talking about that, or is it just this time?
yeah. I mean, I think the .com was a little bit less subtle. I mean, it was more subtle than what the housing crash was. Um, I when during that period of like 07 was 06, I had lunch with a friend and he had quit his job and he was coming down to the coast and he was buying properties, subdividing and flipping them. And he was making millions. And I had lunch with him in January of 07. And I was like, how's it going? And he goes, well, because I'm getting concerned. I'm sitting on like 2 acres. I've subdivided, put it infrastructure in, and I've been sitting on it for 30 days now. I was like, well, what's the typical time? And he goes, a week. I was like, wow. Um, I think that really triggered us at that period in time because I would have those conversations and I had a friend in the mortgage business and he over a couple beers said I made more money than I should legally be allowed to make as a mortgage lender. And he says this will end badly. And he was right. And that was in 07, early 07, as it just when it Bear Stearns went down in April of 07, I think. I think it's more talked about now. I think there's like your point of what Stan Druckenmiller is saying about everybody's anticipating a recession or anticipating all this, so they're preparing for it, which in turn drives market higher. But I was just new in the business in 98, 99. So it was just everything's great.
Well, I don't know. I don't know what the numbers are, but I would anticipate that the amount of people who were around for the recessions and for the .com and the financial um, bust situation in 08, 09, that the majority of the people that are in the markets and doing things now were either very young or didn't remember exactly what was going on. They might have seen their folks talk about it or be affected by it. And so a lot of people, all they've known that are in the markets, and I don't know what the number is, a percentage, it's just my guess, have never had markets where interest rates are higher. And again, they're high, but they're not hugely high. You know, back in the 70s and 80s, you know, we were getting 18% on CDs, you know, houses were going, you know, mortgages were 12, 13%. You know, my first mortgage in 1999 was 7.75%. Okay, we all survived, but a lot of people they've never traded a market that didn't have free money in it. They've never traded a market that really had an extended downturn, you know, over the last 12 years. And then we got in the pandemic, and then, you know, a whole new crew of investors and traders came in, and buy the dip was working. And I think there's still a lot of that out there. And to a degree, it probably worked in some areas, but again, I'm not seeing a broad market rally in any way or means. I'm seeing, you know, some stocks, and you know, I'm looking at a chart in NVIDIA right now, and it's just going sideways, you know. And really, of the amazing seven or magnificent seven, you've got Netflix, Tesla, and Apple are the only ones that I see any kind of upward motion in the last, you know, several days. So the market's waiting to see what happens this week. This week, I mean, it's either going to rip or it's going to not.
Yeah. Yeah, I think it's definitely a sideways kind of thing until you get confirmation of what the Fed's going to do. And then even that, I wonder if that's, you know, buy on the rumor, sell on the news kind of an event. I guess we won't know until it happens. Everything is speculation between now and then. So, but I'm interested. I'm curious to see how Friday goes with quarterly and monthly option expiration being the size it is. I think that'll, if most likely, turn into a run up. But come Monday, that's when I'm, you know, is that floor that has been in place for a while for the last quarter or so, is it gone? And if it is, what happens? So I think, you know, we could see just continue upward movement in the market, in the indexes until Monday morning. So I don't know. We'll see.
Another thing that I was curious is, you know, as a fund manager, let's say a lot of people were on the sides because they were anticipating a recession or downtrend, and the market's actually going up, and these fund managers have to perform better than the S&P 500, right? But if the QQQ S&P 500 is like going 16, 20%, and you're on the sideline, and you're like 2-3%, 5%. I wonder if these guys would be like nervous or anxious and start pouring money in, or try to pull the market down. Or I'm just curious to see how they would make it so that they perform at least how the market is at this point. That's a lot of money, right? So
yeah,
a lot of them don't perform over the indices. I forget the percentage, but
I think it's like 85% don't beat their assigned benchmark.
I think you're right.
That's what it was a number of years ago. I think your private money's got super aggressive after last year. Your hedge funds, your institutionals, and they've gone really way out on the risk spectrum and impossibly taking more risk than necessary, because they had to make up for last year. But I think your general mutual fund has to do whatever the prospectus says. And if you're in small cap, growth, I don't know how that's done for the year, but you have to follow that map. You can't style drift over to value or something else. That's what caused a lot of the big selling during the .com thing. Was you had large cap growth managers holding a bunch of small cap growth stocks, and it started melting from the smaller caps up to the large caps, and they got cooked. So I don't know. I mean, I guess it's a wait and see. I think the thing I think it needs to be reiterated is you really just risk manage. Know your tolerance, know how much you're willing to lose, and what your time frame is. And a couple guys on the Friday call have always said, well, if my time frame's 10, 20 years, why wouldn't I buy Tesla, or why wouldn't I buy NVIDIA or something? I mean, if that's your time frame and you got enough dollar cost averaging involved in it that you can do that, it makes sense. But I think you got to be careful at this point, because we're just in a weird time at this point. So it's my take on it all.
I think you've got to be prepared to take some off the table when you get handed a really good deal. Or, I've experienced where it goes up and you just, the market psychology comes in and your greed factor goes up, and then the next day something happens and it's all down. And, there's nothing wrong with taking some off the table. And, people bring up taxes. Well, I'd rather be paying taxes because I'm making money than not paying taxes because I'm not, and
right.
Kind of been my mantra. But
it's actually a good thing.
Yeah. I'm like, so, or trade in a tax advantage account, and you don't have to worry about it anyway.
Yeah.
But again, it comes back to how old you are, what your risk tolerance is. If you're young and and your dollar cost averaging by every paycheck, putting a 10% or 15% in your 401k, and that's going into index funds or some kind of diversified part of the market, historically you're going to be fine. But you get up to an age where you're out and you're not doing that anymore, then you've got to become a little more conservative and preserve your wealth and grow it the best way you can. And you cannot afford a 26-year or 10 or 15-year portion of the market where it drops and you're waiting for it to get back to even, because you're going to need that money to live on. Right. Majority of Americans.
Yeah. So very cool. Well, anything else? Any final words for the week?
It's going to be fun.
It'll be volatile.
Waiting for it.
I look at the VIX and I go, man, that thing's going to move once they quit suppressing it. So
the thing is, a lot of, I think myself, I think we're in a bear market, or a bull market run in a bear market right now. I think once these things go, if it does, they go quickly, and violently sometimes, like in '87. And no, that's what'll trigger a panic. There's no panic now, as you said, in the VIX. There is no panic. There's no fear. Yeah. The greed index is way high. And all those things, technically are not good for the market.
Right.
So we'll see. I've heard a couple times on CNBC's in the background, and Wapner talking about, well, maybe it's different this time. And I don't wish I had money every time someone told me it's different this time. But
right. What was it? Barron's came out this weekend and said market's got legs. It's going higher. It's the perfect contrarian indicator.
Oh, yeah. Yep.
Yeah. So I don't know. Be careful. Money markets are good. They pay well.
I bought some treasuries today for 5.2%.
Oh, jeez. Wow. Yep. That's nice.
Yep.
Yeah. All right. Well, we'll hopefully all those who are watching have a great week, and we'll do this next week, and go out there and risk manage and enjoy, and subscribe to the Best U.S. Investors below, and check out our Patreon accounts, different levels. We have different services. Check it out, and we'll talk to you soon.